This presentation is created by Nicholas Tan, author of Handbook on Forex Trading. In this presentation, you will learn the basics of Forex trading and how you can become a successful trader. Most of us depends on the stock market for your additional passive income. When there's a bull market, you can make money quite easily. But the bull market does not last forever. But what happens when the bear comes along? How are you going to make money from the stock market? What is your strategy when he eats up your fish? Do you have another way to fish? Forex trading is the other alternative. Why is Forex trading so attractive? First, there is big volume and high liquidity every day. The daily turnover is 1.7 trillion US dollars a day. That is more than the volume of the combined turnover of the New York Stock Exchange, London Stock Market and the Nasdaq combined together. Secondly, you only need a computer with broadband access for Forex trading. So, you can trade at the comfort of your home. Thirdly, unlike stocks, there is no commission charges for Forex trading. There is also no limitation on short selling. You can keep your naked short position as long as you like. Finally, you do not have to spend long hours doing research as trading is usually concentrated on the four major currency pairs. Anyone can trade Forex. People from different walks of life trade Forex in the world. From white-collar workers, executives, to housewives and even students. Anyone about 21 years old is able to trade Forex, and it does not matter in which part of the world you are from. Forex trading is available 24 hours a day. You don't even need to spend on your phone calls to call your broker when you want to trade Forex. The 24-hour market means that you can pick a time when you are available to trade Forex. If you work on the regular time between 9 to 5, then you can start trading when you are back from work. If you work the night shift, you can trade between morning 6 and afternoon 5 p.m. Just pick a time period when you are free to trade. What makes Forex attractive is that there's a good daily movement every day in Forex. A typical daily average movement for the euro, US dollars is about 100 pips a day. For GBP or US dollars, it is 130 pips a day. Good movement equates to good profit. Let me give you an example. For a standard contract of 100,000, that 100 pips movement is worth 1,000 US dollars. If it moves 130 pips, it is US dollars 1,300 dollars. Profits like this can be made every day, and it is only based on a single contract. But Euro people say Forex is so dangerous. There is myth that Forex is too volatile to trade. But the reality is that 99% of the time, you can get in and out at your desired price. Most broker will even execute your stop loss at the stated price. However, volatility has its advantage. Volatility equals movement. Hence, you do not have to worry about the currency pair you bought is not moving. Is Forex dangerous? Can you lose lots of money? The reality is that you will not lose more than your deposit. Although Forex is traded with 50 times leverage, leverage is only limited to your deposit. If you were to put in 2,000 US dollars, you can only buy 100,000 US dollars. Your position will be closed when your loss is 2,000 US dollars. There will be no margin call. You only lose what you have in your account. Unlike equity, no one has ended up as a bankrupt trading Forex due to the no margin call, enforced stop loss policy. In my humble opinion, Forex is actually safer than stock trading. But that is not to say you will not lose money trading Forex. The biggest reason for losing for most traders is because they did not put a stop loss to their trades. As Forex movement is volatile, it is best to leave a stop loss order to ensure your capital safety. The other reason is that there is no proper trading plan. Other reasons for losses includes greed and overtrading, no knowledge of trends and technical analysis. The Forex market is very technical, and charting is a very useful knowledge. Knowledge is the key to success. If you do not want to lose your hard-earned money, you need to acquire knowledge and skills. Earlier, I have talked about the attractiveness of Forex trading. Now we come to the basics of Forex trading. After this talk with this basics, you will be able to start trading on a demo account. Later I will be showing you some demo accounts and how you could simply open an account. This section of the talk we will cover buy or sell currency. What is the reference and port currency? What are pips and spread? What are standard contracts and mini contracts? What are the 5 major currency pairs and how to calculate your profit and loss? In the US dollars, Japanese yen currency pair in this example, the US dollars is the reference currency while the Japanese yen is known as the core currency. The price that you see, 119.68/7B, is the broker's price. Your broker is buying or known as the bid price of 68 and selling at 70, also known as the asked price. If you want to sell, you will need to sell at your broker buying price of 68. If you are buying, it will be at 70. You will have noticed there is a difference of 2 points or pips, as we call it in Forex. That is the spread your broker is quoted on. That represents your broker compensation. By the way, almost all brokers in Forex do not charge commission when you buy and sell. They only earn on the spread. Standard contract is 100,000 of reference currency for a single contract. For instance, the Euro-US dollars currency pair, a standard contract would be 100,000 Euro-US dollars. For many contract, that would be 10,000 of reference currency. These are the major currency pairs. Euro against US dollars, UK sterling against US dollars against Swiss francs, US dollars against Japanese yen, and the Euro dollars against Japanese yen. This is an example of how you calculate your profit and loss in your Forex trade. As can be seen from the example, if you were to buy Euro 100,000 against the US dollars at the rate of 1.3101, the US dollars amount would be 131,010. If you sell at 1.3102, which is a 1 pip profit, the US dollars amount would be 131,020. That would leave you with a US dollars profit of 10 US dollars. Now we come to opening an account with the local overseas brokers. For our local brokers, there are CMC markets, IG markets. The advantage is you do not need to remit money overseas. You will not lose money when converting into US dollars. For overseas brokers, there are Oanda and FXCM. All the above are for demo account, but Oanda is the best as there's no expiry date on your demo. The other broker's demo account varies from 2 weeks to 4 weeks, after which you will not be able to access the demo account. CMC markets. 6 simple steps to opening an online demo account or real money account. IG markets. You will need to fill up a form and fax or post to them. Demo account is valid for 2 weeks. 3 simple steps for opening an Oanda real account. It is similar to opening a demo account. Is Forex trading complicated or hard to learn? Well, there's no complicated trading method. Our trading method is based on simple trading setup. The trading plan is based on pattern setup with a confirmation indicator. Once you get the confirmation or trigger, you would enter into a position. Some of these patterns are available in the book, Handbook on Forex Trading, written by Nicholas Tan. Here are some examples of those simple patterns that you can learn from the book. The first pattern is a rectangle pattern. Once it breaks the trend line, you have a sell signal and you can short the market. On that same day, we have another pattern, a bearish engulfing pattern. This tells you to short the market. On the next day, we got a simple trend line breakout. Again, this is a simple buy signal and you go long. This is a profitable pattern. In the Forex course that is conducted by Nicholas Tan, you will learn to recognize more patterns that gives you a high probability to trade successfully. Another example. This time you have a MACD divergence setup. Once the trigger is broken and confirmed, you can enter into a trade. Another similar MACD divergence pattern happened again the next day. On the chart, you see another MACD divergence pattern on 18th September 2007. On the 19th September, you got a bearish engulfing pattern. On the 20th September 2007, you got a hammer and morning start pattern. You just saw another 3 more profitable patterns in 3 trading days.